Hi, I'm Nick at RSZ Accountancy. One of the questions that we quite often get asked is, as a director of a limited company, what are my rights, what are my obligations, what do I need to do? Now, obviously, if you go and trawl through the Companies Act, and it's going to be thousands of pages and multiple rules of legislation, what we wanted to focus on in this video here is one of the key ones that we really get asked, which is, what are my responsibilities in terms of what records do I need to keep? What are my accounting records? So what I've done is I've actually gone along and taken the extract from the Companies Act, so you'll understand what it is in chapter and verse, but then I'm going to take you through, as we go through, and effectively translate it, so it gets from the legislative terminology into a normal everyday speech, so you understand what it is you need to do. So it's actually covered by section 386 of the Companies Act, which covers the director's responsibility to keep accounting records. So I'm going to take you through this, and anything that I get to and go, that's a bit jargony, I'll translate it for you as we go. So the first part is every company must keep adequate accounting records. And again, this is the question that we're getting asked. What's considered adequate? What do I need to keep? And it actually goes into some quite good detail. So adequate accounting records means that records are sufficient, firstly, to show and explain the company's transactions. So, for example, and again, translating this into normal common sense, the majority of companies' transactions are always going to be in and out of the bank. So, you need to understand when money goes out of the bank, you have to keep a record to say, yep, this is what it was for, here's a receipt for it, and this is why it was a business expense. And exactly the same with anything coming in. The chances are this is going to be something that you've invoiced to one of your customers, so you'll have that invoice, and then you can match the two up to say, this money coming in from into our bank account was the payment of this invoice. Section B is to disclose with reasonable accuracy at any time the financial position of the company at that time. So, what that actually means in terms of the financial position of the company is really what the company is worth. And a company's worth can obviously be moved by a lot of things like, goodwill and, what clients you've got, what they're worth. But in raw terms, what a company's worth is what it's owed, what it owns, and what it owes out. So, for example, you may have a positive bank account, so that would be an asset. That would be part of the worth of the company. You might have bought 4 computers and 3 desks. They are assets of the company, so again, that increases the worth of the company. On the flip side, you might have suppliers that you owe money to. So therefore, that is a liability of the company. That's something that the company owes out. So if you take your fixed assets, which are your computers and your desks and things, plus your current assets, so stock you might hold, monies you're owed from your customers, positive bank accounts, and then you can deduct from that the liabilities, so money you owe to your suppliers, money you might owe to HMRC for VAT or PAYE, monies you may owe out to the directors who have invested money in the first place. That gives you the financial position of the company, which is why it's so important to go along and to go beyond this. I'll just quickly put together an income and expenditure spreadsheet. That's never going to show you what the financial position of the company is, because you don't know at any given point what you're owed, what you owe out. All you're doing is recording cash, which isn't sufficient to show the financial position of the company at any time. The next part is also to say to enable the directors to ensure that any accounts required to be prepared comply with the requirements of the Act. So again, this is where we will go along and take the information provided by our clients from their bookkeeping systems, from whatever they've got. We will then turn that into a set of accounts based upon the information you've provided and the explanations you've given us to anything that we've queried. You should then be able to have a look at that set of accounts and to say, yes, this does show a true and fair view of the position of the company. So you can only do that if you've got adequate accounting records. The next section is accounting records must in particular contain. So again, a little bit more detail here. Entries from day to day, all sums of money received and expended by the company and the matters in respect of which the receipt and expenditure takes place, which again, this is why I said I'll translate the jargon. So what it's actually talking about is exactly what we've mentioned earlier in terms of bank transactions, cash transactions. What was that money out for? Do you have a receipt for it? What was that money in for? Do you have an invoice out to a customer? Was it something you didn't invoice because it's a one-off job that you haven't invoiced or something? Was it bank interest you've received? Whatever it is, you need to be able to explain that transaction if ever queried by us when we're going along and actually preparing your accounts, or by HMRC if they decide to investigate. So that deals with all monies received and expended, so in and out. The record of the assets and liabilities of the company. Now, I don't have to harp on about that again because I've just mentioned assets and liabilities. And if you have picked up to this video 4 or 5 minutes in, go back, watch the bit that you've just missed, because that will tell you all about assets and liabilities. So you've got your fixed assets, your current assets, and your liabilities. So you must have a record of all of those, which is one of the most common things that's always missed when we just get a spreadsheet going, here are my ins and outs. It doesn't help us know what the assets and liabilities are. Section 4, if the company's business involves dealing in goods, so if you are a business that buys and sells computers, calculators, stock of any kind at all, you must also have a statement of the stock held by the company at the end of the financial year. So let's say your year end is 31st of March, you should have a record of a stock take or something that you've done to say, this was the value of my stock at the end of the year. And you should also have all statements of stock takings from which any statement of stock is mentioned or has been prepared. So again, you might do stock takes every quarter. You need to retain that information because it's giving you an accurate position of the assets and liabilities of the company. Section C covers, except in the case where goods are sold by way of ordinary retail trade, statements of all goods sold and purchased showing the goods and the buyers and the sellers in sufficient detail to enable all these to be identified. So the translation of that is, if you've gone along and bought, we'll use calculators for example, you go along and you are a manufacturer or a distributor of calculators. So if you go and buy 10,000 calculators that you bought from Casio or whoever you bought them from, you should have that supplier invoice that says, this is who you bought them from, this was how many calculators you bought, this was the date of it, this was the value of those calculators. Then you've also got when you sell them out to customers. Now, you should have sufficient information to be able to identify who those customers are. You can't just say, John bought 50,000 of them, because that's not sufficient detail to be able to retrospectively, so go back and to work out, well, who was John? 50,000 calculators to John isn't sufficient detail. So what you would then have is you might have John's calculator shop, one in the street, some town, some place, postcode, what his company information is, what his details are. So you can retrospectively go back and know that, yep, you brought in 50,000 calculators from Casio and you then sold those 50,000 calculators to John's calculator shop. So you've then got that adequate record of where the stock came from and where it's gone. So, but the key point here is in the case of retail. So in John's calculator shop, John doesn't have to go along and interrogate every single customer who comes into his shop and says, I need your full name, address, and the details of any business you're involved in so I can create a full invoice, because in reality they're going to go along, buy a calculator, $9.99 and get a little receipt. John doesn't need to keep track of every customer he sold to because he's selling retail. But when you're selling trade, you need to know what came in, where it came from, what went out, and where it went to. So hopefully that clears that one up in terms of stock. Now, the nice part is, and I know you think that's fine, and thank you very much for this, but what I now want to do is to take you to the next step of the Act. So we've just done Section 387, Section 386, the requirements to keep accounting records. Now I'm going to take you to Section 387, which says, what if you don't? Because this is the one of people going, that sounds like a lot of hassle. I don't want to do that. So let me tell you what happens if you don't. If a company fails to comply with any provision of Section 386, which we've just gone through, an offence is committed by every officer of the company who is in default. So every officer is every director of the company can be liable because they have not kept adequate accounting records. Section 2. It is a defence for a person charged with such an offence to show that he acted honestly and that circumstances in which the company's business was carried out on the default was excusable. Which means if a director is not really involved day to day, but you've got a financial director who's responsible for keeping those information, that other director has a chance of going, well, it's not really my responsibility, it's not my duty, so he has a reasonable excuse as to why he hasn't. However, if he doesn't have that, he is as liable as every other officer in the company. So, let me tell you, Section 3. A person guilty of an offence under this section is liable. A. On conviction on indictment to imprisonment for a term not exceeding 2 years, or a fine, or both. So, to give you an idea, that was, if you decide not to keep accounting records and HMRC come in and have a look, and they find you guilty, you can be imprisoned for up to 2 years, and so can every director of the company. And you can also get fined, and I think the fines are anywhere from 200 quid to £5,000. And I would imagine that they'd also give you the time to rectify, and if you haven't rectified, they'd probably come and re-fine you. So there are slight variations of this in terms of Scottish law and Northern Ireland and, in England and Wales. But hopefully you now have this understanding of A, what you need to do, and B, what happens if you don't do it. This isn't a small matter. This isn't oh, well, never mind, I'll get a slap on the wrist, I'll get a 500 quid fine. Yeah, you might do it if it's only a light offence, but if you are literally trading and you're not keeping those records, which bearing in mind, do remember that HMRC can choose to inspect these at any time. And obviously you're dealing with the Companies Act, which means Companies House, if they wanted to, could send compliance officers to go along and ensure you're doing what you're supposed to be doing. And if you're not, now you know the punishments. So keep those receipts, keep those records. If you need help with this, if you go along and think, oh, I just thought bookkeeping was easy and I'll just chuck it on a spreadsheet and that's fine. If you want a more complete set of records, go and have a look at a Xero or a QuickBooks, because even though it's like, fairly simple entry, you're then starting to record, while you might not even realise it, the assets, the liabilities, explaining all of the transactions out of the bank, because a system like Xero is going to import all your bank transactions and is going to ask you to explain what everything is. It's not doing it to be difficult, it's not doing it to try and create more work for you, it's doing it to make sure that you comply with the Companies Act. So, if you need any help with this stuff, if we can help you with your bookkeeping, or you already have an account service with us, but you think, hang on, I'm not probably doing that, by all means, give us a call and we'll see how we can help. I hope this video has been really useful to you and look forward to speaking to you soon.